if you take a property and let's say you move a tenant out and you've got a $3,000 turn and you're going to miss a month and a half or 2 months of rent and you got marketing costs, you're down $5,000 right there. So if you bring in a new tenant at $100 a month, it's going to take 4 or 5 years just to make that up.
Hello, hello. Ginny Bolling here with the Pivotal REI, Pivotal Real Estate Investment Podcast, brought to you by Pivotal Real Estate Investments. And today we have David Priest with us. David, thanks for coming on.
Thank you so much. Glad to be here.
Well, I appreciate the fact that we're getting a chance to do this right after I met you even. And we were just at a conference that you were a critical part of the show, I would say. I appreciate the fact that you had so much going on and we got to go break bread, have dinner. But or was it lunch? What time of day was it?
Dinner. Yeah, it was dinner. Mhm.
Anyway, so tell us how you got into real estate, please.
Well, I did what I would like to call like transactional real estate for about 20 years. And this was from 2003 up to 2023. And I was a mortgage broker. I had my real estate license as a real estate broker here in Texas. And so I did, that's what I call transactional. And then in 2023, I started making the transition to like owning real estate. It's interesting because all during that 20 years, I didn't buy any single families. So I was a stock market investor, got really heavily in the market after 2008 when it crashed. And then I started getting more interested in the real estate market and apartments in 23 when I heard there was a lot of problems and a lot of opportunities and prices were way down. So I started getting interested in that. And I saw a lot of parallels. So I started getting into it then and kind of educating and learning. I took probably the first year of 23 really trying to learn everything I could before I jumped in on a deal. And then I was going to go out and kind of do it on my own. Found out that that didn't work, but I did find out I was good at raising money for people's deals because that's the part of the deal that I was working on that went really, really well. And so I went in and just started, being a professional fundraiser independently for other people's deals, and that's what I do now.
All right. And so we might as well talk about the elephant in the room that comes up with that. And that's do you have a license in securities or do you do it through the fund model?
No, I do it through a fund model, and I also am a co-GP on a lot of my deals too. So I don't have any kind of securities license or anything like that, but I do follow all the applicable SEC laws, whether it's our 506B or 506C. So I do follow all those laws. I know them very, very well. I've done the co-GP model on most of my deals because a lot of my deals are right here in Houston, and I'm an expert in those markets. And I do pay attention to what's going on with the management. I've helped vet property management companies when we've had to replace them on properties and things like that. But I generally don't jump into managing on the properties unless the deal is starting to go a little bit sideways. And then I'll hop in and like, hey, I need to help out with this. And they need my input at that point. So I'm always there willing to help. But a lot of my time is spent working with my investors and also looking for new deals for people.
Gotcha. Okay. And one of the funny things about Texas, for me being in Florida, is it's a non-disclosure state. And I used to be an appraiser, so I like to know what a property sells for. So how do you deal with that? How do you know what a property really sells for?
Well, obviously the appraisal district will send out a survey and they ask you to volunteer the information, which basically nobody does. You can find out from brokers kind of under the table what things are selling for, or sometimes some of that data will be out there. But yeah, it's a non-disclosure state, so that information is a little bit harder to access. I think if you go into like the professionally like paid subscriptions like CoStar, you can find that information, but it's not readily available.
Yeah, I get co-stars on all those, but I don't get the warm and fuzzies. So what I end up doing, since I have so many friends that are appraisers, as I call appraisers, interesting. One of the discussions I had with one of them got into just that, and I asked if they rely on CoStar, and they said, no, they rely more on ALN. Are you familiar with ALN?
No, I'm not, but I'm not a professional appraiser. So, I mean, I don't have a lot of knowledge in
Yeah,
that
we're a national firm that
expertise.
only does multifamily, so that's pretty helpful to them anyway. But anyway, so what kinds of properties do you like?
Right now, I've gone more toward the like A-class type of properties. So I like things that are built 2005 and after. So built in the last 20 years. We're going to more A-class, big city, suburban, out low crime, good demographics, high income areas. And we're trying to buy properties that are discounted because the operator's in some type of distress or the debt's in some type of distress. So we're trying to buy an 8 or a 9 and pay a 5 price on it. That's what we're trying to do right now.
Yeah, I totally get it. And I think this is the prime time because as you know, we're in a dip, right? So that's what a lot of us are looking for. And so if you find some good stuff, let me know too, because I'd like to raise money for you probably.
That's a deal. Yeah.
I love the idea of getting some newer stuff at a discount, of course. Yeah. I'm
Yeah.
in
And if the market's really good, it maybe things we don't sell. So we might take those deals, invest in them 5 years from now. The market's really good. You can sell or you do a cash out refinance, give people all their money back and let the deal keep growing. So we look at that as a possibility. Um, but generally, our exit strategy is to sell within 5 years, exit early if we can. And I've got deals I started in 24. So I'm 2 years into some of my deals now, and those will probably exit in the next few years.
I know we can only say so much about the returns typically, but um, are you able to give me a quote on a range of what you're looking at on yours?
Yeah, I mean, I think realistically, if you're looking at, like, say, a Class A property and you're using fixed rate debt and you're not over leveraging and you're not taking a property that's got a lot of problems, you're getting regular Fannie Mae fixed rate debt and your occupancy is 90% or better to get that kind of debt. You need, the 90 for 90% for 90 days. And you're going with these safer type of deals, your returns are probably going to be somewhere between 15 to 20% a year. Okay. Might be a little bit better. If we exit early, they'll definitely be better. But the way we look at it, I don't look at real estate as like a home run business. Okay. I look at it as like this is a wealth building business. This is done over time. And you need to be very careful about not going for high risk deals or home runs because that's when you run into problems. And if you lose money on a deal, you're not going to be able to make that up by finding other, good deals. I mean, basically, your goal should be to never lose money in real estate. And if you have that as a goal, you'll always do real well. But if you're going off and swinging for the fences and taking a lot of risk and you lose money on deals, you're really going to hurt your returns.
Right. And your reputation.
Yeah, definitely. All the above.
You were saying 90% what on that? 90, occupancy.
The 90 for 90. I mean, what that means is like if you're getting a Fannie Mae, Freddie Mac, or HUD loan or any of the agency loans, you need to have an occupancy that's 90% or higher for 90 days. So generally, when you do your contract, the closing is 90 days. You've got to keep the occupancy up. They will not finance deals that are below 90% occupancy. Another good benefit of those type of loans on your operators is they do massive amounts of due diligence. So, I mean, I always obviously do my own due diligence, but if you're going to go sign and say a 30, $40 million Fannie Mae loan, believe me, the operators are getting checked out 10 ways to Sunday more than anybody else, the due diligence that anybody else could do on them. So they're getting checked out pretty good. That's another reason to go with that kind of financing rather than going with, someone doing bridge debt.
Agreed. Right. And what kind of loan to value are you talking about typically?
I mean, I'm right now I'm seeing anywhere from 50 on the low side to 70%. But I mean, 50 is not unusual right now. A lot of people are raising a lot of money, 50 to 60. And I've done deals recently as high as 70, but I don't want to go over 65 or 70. And the key factor is you want a deal that's going to cash flow day one. So you want a DSCR initial 1.2, 1.3, 1.4, in that range minimum. So 1.25 minimum. up to maybe 1.5 or 1.6. I'm doing a deal right now where we're doing a loan assumption, and it's a HUD loan with a very, very low rate. It's close to 3% on the rate. And we've got a DSCR on that deal of 2, because it is such a low rate, and we're using lower leverage because we have to assume the loan. So we've got to raise a lot of equity. So the higher that DSCR is, and the DSCR is the net operating income compared to the debt payment. So if you're have one of 2, what it means is you're collecting twice as much money after expenses cash flow before you pay the mortgage off, and the mortgage is only half of the cash flow you're generating. So it makes the deal safer. It's a measure of how much cash flow you're getting right away and how safe you are. And when I analyze deals, that's the only number I look at on the front end. So I'm different than most people. I look at the numbers last. So most people, they look at the numbers first. What's the IRR? What's the preferred return? What's this? What's that? I look at the debt structure, that one number, DSCR, the experience of the team, and the location and market before I even look at numbers. Because if the deal fails one of those tests, looking at the numbers is irrelevant, and the numbers take longer to analyze. So I'm trying to save time, basically, by eliminating other things.
How do you get the DSCR so quick without having to do the market analysis?
The first thing I ask, I mean, when people send me a deal, I'll tell them, make sure you include the lender initial DSCR right at the top of the sheet. And I can look at that and I can know if it's cash flowing day one or not. I can see the term sheet from the lender and see that that's on there. And I know if it's a 1.25 or less, or if they're getting, bridge debt. I don't want to do bridge debt. But an agency debt, you need a 1.25 or better to even qualify for a loan. So if they're getting, HUD, Fannie Mae, Freddie Mac, agency type of debt, it's going to be better than 1.25, which is going to be my minimum too. And then I try to look at it 1.4, 1.5, 1.6 is kind of a sweet spot.
Yeah, definitely. They're hard to find.
Yeah. I mean, you're looking for deals that the whole idea is to find a deal that cash flows right now, that you can get fixed rate debt for 5 years or greater. And then there's a plan to make it cash flow better without taking too much risk. So that's what you're looking for. It's kind of the sweet spot right now.
Can you get fixed rate with interest only?
Yeah, of course you can. Yeah, of course. Yeah. So
yeah.
generally you can get a Fannie Mae loan, and let's say you can get like 7 or 10-year debt. You can get interest only for 2 or 3 years. So interest only is going to make the deal cash flow better, but you need to realize that, in 3 years, you've got a hard stop, where it's going to change. Now, I've seen people get 5-year debt with 5 years interest only too. It's out there. You pay a little bit higher rate, but it's definitely out there. And I think it's good, but 5 years is really your minimum. So, I mean, what I don't like about bridge debt is obviously you don't know where rates are going to be in the future. You're generally starting out with a deal that doesn't cash flow right away. And you've got a very short runway, usually 3 years, to turn that deal around. And so you're already starting off with a challenging deal, and you're giving yourself less time to turn it around. And that's where deals have gotten into trouble, is variable rate debt with a very quick period that we need to turn the deal around, and then a more challenging property. The occupancy is low. It's in a bad area. And that's certainly too with the location. You can't change the neighborhood. If you're in a bad area, in a bad neighborhood, I just had a conversation with someone at Ultimate Partnering about this. And, someone called and they were looking at a property and said, that looks, kind of, I don't know about that, kind of in bad area of town. I know Houston pretty good. And someone said, well, I just drove the property and like everything looks good over there. And I'm like, it's 10:30 in the morning on a Tuesday. That's not what the property looks like. I said, go over there at midnight, Saturday night, and tell me if you're afraid to get out of your car or not, and tell me how the neighborhood looks at that point. So at 10:30 in the morning in a bad neighborhood, everyone's still asleep pretty much. So you don't see a lot of problems. So yeah, I mean, you can't manage out of that. And people, they will buy properties in bad locations or bad areas thinking they're going to manage out of that, and you just can't do it. So I stay totally away from that. I want to be in good neighborhoods with lower crime. Does it mean there'll never be a crime at the property? No. But I mean, why would you buy a property where you know there's going to be crimes? There's going to be stuff happening all the time. Why would you want to do that? And the interesting thing, though, about crime is if you get a crime at a high end property like A class, it has more of an effect on the property sometimes as far as the tenants. Like people in bad neighborhoods that are more workforce housing, they expect there to be problems and stuff to happen. They expect it. And I had one of my properties that like, there was a big brouhaha about it. And they said, well, there was a crime on the property. What happened? I thought, this is horrible. Somebody got killed or assaulted. And it was like somebody got like their catalytic converter from their BMW stolen or whatever. And I was like, this is not a major crime. It's not good that it happened. But I mean, this is not something where the residents should panic at this point about crime on the property. So you want to try to stay away from places that are higher crime, and you're not going to be able to manage out of it. And if you buy, the whole thing used to be, if you bought a property cheap enough, it was worth it in a bad neighborhood. And I just don't believe that. I mean, you need to look for quantity value. I do an older property that's in an incredible neighborhood that's low crime, and those are hard to find. You got to find a neglected property in a good neighborhood.
Agreed. So let me ask, is there a preferred app you use to check the crime in an area?
Crimegrades.com. I don't really use an app. I mean, I'm old, so I'm like a desktop person. So I mean, I don't use like my phone that much unless I absolutely have to. It's kind of a last resort. But yeah, I use crimegrades.com, and it has maps, and you got to read into the map a little bit easier. And you also got to look because you need to know the submarket and be able to drive the area. I mean, there's places like in Houston, I'm sure there's every city where you got a good patch where people live over here, and then you cross one road, you go 250, 300 yards, and it's like a totally different world. Some of the inner city places, like there's a good area here, cross a major road, get on the other side of the major road, and it's a really rough neighborhood. So that you've got to look at that sometimes, but a lot of it is looking at the crime grades map and then looking at, is this something where crime is going to be a major problem? And when it is, for me, it's a hard no right now.
So it's funny that you were also referring to the people in the higher level, the A class properties. Have you gotten into doing extra measures beyond the norm on security for any of your
Well, I
projects?
mean, when you get to like the A properties, you're going to have a lot less of a problem. Most of those have security gates all the way around, and they're fairly well controlled. I think one thing that really helps on those that's a cheap fix is cameras. You generally don't need a security patrol all the time. Sometimes you can bring that in if you're having trouble. When you have a higher crime area, because security patrol is almost like a necessary thing you've got to add into your expenses. So hopefully on your A-class properties, you don't need it all the time. One thing we found is if you can give some discounts to local law enforcement, especially when they will park their law enforcement cars at the property, and you give them a really nice apartment right by the gate, where the entrance is, and you give them a discount on that, and they'll park their cars out there, and the cops are going back and forth. You get 3 or 4 policemen in your complex that park their cars there. It really helps a lot. It's cheap. It's a lot cheaper than security patrols. And if people drive up and they see a police car sitting right there, they're generally going to move on. So
Nice trick. Yeah.
yeah, we haven't used any. We use the real policemen, real police cars. Years ago, I used to be in sales, and I sold BMWs many years ago. And I was delivering a really high-end BMW to a guy who lived in a really wealthy part of Houston, River Oaks, which is like the ritziest neighborhood in Houston. And he had a security area, and he had like a booth out there. And a couple of nights a week, he had some kind of like ex-military Navy SEAL guy man that, but not every night. It was like intermittent. But he had a police car parked in his driveway. And so I asked about the police car in his driveway, and he's like, yeah, it's there all the time. And I said, well, how did you get that? And he said, well, I went and bought it at the police auction. He bought the old police cars, but he took like the old crappy one they saw at the auction, and he took pictures of a regular car, and he went and painted that one where it looked like a brand new police car sitting there. And he said it didn't even start. It was like, so old it hadn't started, but it was painted. And if the police in Houston changed their colors or did a different scheme or whatever, he would repaint the car or go buy a new one. And he just sat there all the time. So We haven't resorted to those security measures, but having policemen park their cars there is good. And then also cameras are good. And the cameras have to be high enough where they can't be defeated. Like they're looking down 40 feet high in the sky. And that definitely helps. But I mean, hopefully at our complexes, we're in nice enough areas where the crime is not going to be an issue.
Yeah, yeah, very good. Well, that's funny. So now when you're fixing up units in any of these B or A or B type projects, what kinds of things are you doing? Are you doing the standard granite and light fixtures, plumbing,
Yeah,
or
yeah. A lot of our properties already come with a lot of this stuff, so you can't do a lot of upgrades. A lot of just regular turns. Now, we're able to find older properties that say 2015. We're buying one right now in Dallas. That's all classic units. Like they've never had any capex done to them. So the original owner sold it. The new owners bought it 5 years ago. They were planning on doing a lot of renovations. They got in trouble with their debt structure and bridge debt, and they started sending money to the mortgage company instead of spending money on the property. So we were able to inherit that. So what we found is working really well right now is focusing on renewals. So and try and do anything you can to keep people on the property. Okay. So I mean, it doesn't make it, this is going to go against people's common wisdom because everyone's going to tell you, oh, you can raise rents $100 a month or whatever. But if you take a property and let's say you move a tenant out and you've got a $3,000 turn and you're going to miss a month and a half or 2 months of rent and you got marketing costs, so you're down $5,000 right there. So if you bring in a new tenant at $100 a month, it's going to take 4 or 5 years just to make that up. And our tenants are generally staying about 2 years or less. So you're really never going to make it up before you have another turn. So we're trying to like not raise rents until people move out. And then we'll do a standard turn, or if we're going to do some renovations, we're not going to go out and renovate every unit. We're going to go renovate one and then try to get a higher price and test the market and then see if it'll take the renovation. But we're doing it organically as people move out when we cannot renew. For the gold standard right now is you got a person paying $1,200 a month. Maybe the rents are a little more, and you tell people, hey, we'd love to have you as a tenant. You paid on time. Let's do it. Now, if you have a tenant that's a problem, or if you have a tenant that is delinquent constantly, they're on the edge of a eviction all the time, then yeah, maybe on that person you get the rent, you go for the rent bump on them, and they move out, or they take the rent bump, or whatever. They're a pain, and so they deserve to pay a higher rent. But the people that are paying really good are gold, and you're not going to move these people out and raise rent $100 a month and make money. Your costs are going to go through the roof. It's too expensive right now.
right now, Houston, part of that effect that's going on that's not been said yet, I think, is the supply went bonkers there, right? The last couple of years,
Yeah,
bunch of new product.
we're not. It's not as bad here as Dallas or Austin. San Antonio is pretty close. I mean, San Antonio had the thing. Now, most of that supply came on in 24, and it's being worked through right now. And if you go out to 27, which is only next year, it sounds incredible. I think there's only like something like 1,500 units coming online in the whole city in 27. There's basically been no construction since 24. It just basically shut down completely. So it's too hard to develop right now. There's labor problems, there's tariffs, there's so much risk. There's like as far as me, I don't do any development because I just feel like right now there's so many great deals where you can buy a 5 or 10 year old complex at a 30% below replacement cost. Yeah. Why would you want to go build something at a higher cost with all of the issues and problems and risk and all that? Get no cash flow for 3 years, get no depreciation. I mean, development to me just doesn't make any sense right now. I tend to favor existing projects. And right now, if you look at what developers are doing, they're just not building the type of units they do, which is going to cause a supply problem, which is going to help a lot more with what we're doing, buying these A-class deals, because they're going to have no competition in 27 and probably 28. Now, people will start building again, but they're always behind the curve. They were building way too much in 21 and 22. Market's bad. Let's don't build enough. The market's really good again, and they'll start building again. But when you have a 3-year cycle on that, it's 2 years to build the property and 1 year to stabilize it, you're always going to be behind the curve. It's hard to predict what's going to happen in the future.
So true, so true. Um, as far as amenities at some of these properties, are you getting into anything unusual, or is it all pretty standard?
Not really. I mean, probably the biggest thing amenity wise, and I'm certainly not an expert on the amenities. I'll let my operators figure that out. Pickleball courts, probably the biggest thing now that if you have room to put one of those in, and there's, obviously smaller than a tennis court, so that you can fit them in places like a tennis court wouldn't work. So you are seeing more things like that. Obviously, dog parks, having people having dogs is that's been a big thing. So that's an amenity. I've seen some of the properties now, some of the more high end stuff, and they're doing like saunas and they're doing like red light therapy, rooms and things like that. There's no cold plunges I've seen. I know cold plunge is like a big thing right now, although in our apartment complex with a swimming pool in January, you can do a cold plunge without having to pay for it. So if the pool is unlocked, you can just jump in there. So yeah, I mean, I would say the biggest thing right now you're seeing is like pickleball courts, probably the new thing right now, and you can fit that in a lot of places.
But you can charge for the saunas or the red light therapy.
Yeah, I mean, I don't know if they're just putting that in, but I mean, yeah, I mean, I don't know if people have to pay for that individually or they're just putting it in there and just like, hey, we got something different nobody else has. But those little sauna boxes are not that expensive. So I mean, they can throw that in there and it's not expensive at all.
Have you seen any green rooms?
No, not yet, not yet.
Pastors, I've seen that. Yeah, yeah. Well, and then conference rooms are good for a lot of people that work at their building and things like that. But that's kind of old hat now, right?
Yep.
So as far as what you're looking to do over the next 5, 10 years, what do you see as far as the market and what are you going to do?
Yeah. So right now I'm working on finding A-class properties that are well below replacement cost, or I mean stuff that's distressed where the property's not distressed, but the seller is distressed. So we're trying to find things where the seller's in trouble, they have to sell, we can buy at a discount. That market will probably last for a few years and then the prices will come up. I'm probably going to at some point, if we have some monster exits, and we probably will, is I will move to like taking investors and raising money for some other asset classes besides multifamily. Like if we had this cycle and it's really undervalued, then I feel like it's a little overvalued again. I'm going to look for very conservative deals or longer terms, or tell people, hey, we just killed it on this deal, but you might want to put some money over here. So I'm trying to learn some of the other commercial real estate asset classes like retail centers or medical office, and just I'm going to invest in some of those myself and try to learn some of those, because I think you could have a cycle where the exits won't be as good on the next part of the cycle. Hopefully within 10 years, I'll be done, like totally retired. So I'll run a family office and I'm going to exit as a passive and try to be the world's greatest passive investor along with my kids.
Yeah, there you go. Well, I'll tell you I look at a lot of different asset types and the medical, especially with so many of us baby boomers that are going to need medical facilities. There's so many procedures that are normally done in a hospital. They're moving to these ambulatory surgery centers.
Yeah.
It interests. I never appraised those before, but I've looked at them now as a investor, and they really are an
Yeah,
interesting.
you've got that. And then you also have like on the medical office, like even like practitioners like dentists or things like that, they put like $1 million worth of equipment in the office and kind of build it out really nice. And all the stuff is set up there. And they don't want to move into a different location. So they sign long-term leases. The rents are built in to go up. A lot of the costs are triple net, so they get passed along. So, I mean, your profit, I mean, they're not home run deals, but it's very, very, very predictable how much it's going to cash flow because the rent bump's already built in and your expenses can't go out of control. I mean, don't you wish we could have multifamily people, hey, you're going to be there 5 years, your rent's going to go up 3% a year. And if our costs go up, we're going to raise your rent and you get to pay our costs. So some of those asset classes, there's a lot of wisdom in what they do as far as the predictability of the cash flow.
Right. We like to say we like boring buildings.
Yeah, exactly.
Have you, oh, I forgot to ask you, what is your takeaway that you want people, the listeners to take away from listening to you?
Well, what I would tell people is in real estate, you need to invest in real estate. So you need to be investing however you can get in. I mean, I like the passive investing side because you can go off the expertise of people that have more experience. I think the main thing is you want to not go for home runs. So invest stuff that's steady. Find operators that are really good to be doing this 10 years or more. Only do fixed rate debt. Aim for a 15 to 20% return. I mean, a 20% return is double the stock market over the last 100 years. So aim for those kind of returns, get good tax benefits, but don't think of real estate as like a get rich quick scheme. Look at it as like this is long-term wealth building. I can build faster than I can the stock market. But my main thing is I'm trying to avoid losing money. And if you have that kind of attitude, I think you'll do really well.
I think that's really good advice for sure. Um, all right. Well, so anything you want to add? Any stories that are fun to relate to? One that's not so fun. Well, you're going to get to that, I guess, when I ask you the pivotal question. But any other stories you want to add in before I ask you that question?
No, no, it's all go ahead.
Okay. So, like I ask everybody, is there a pivotal person or event that brought you to where you are today, or is pushing you towards some set goal?
Yeah, I think with me, the preparation I had for when I got into commercial was in 2022. I got diagnosed with leukemia, and I was a relatively healthy person. This kind of came out of nowhere. Caught it very early with a blood test, and had very minimal type of treatment. I didn't go through the hell that a lot of people go through with cancer treatments, and I was extremely lucky. But going through that caused me to kind of reevaluate my life, and am I doing what I want, and am I doing the most, kind of am as good as I could be? Can I, be a higher person, have a higher level of purpose, and do more in my life? So I kind of question everything. And then also, when you go through that, you realize like life is short and you want to go do everything you can every day. So it's something that's continued to propel me. And I think that's something that changed my life right before I got into commercial real estate. And it's helped me carry through the whole time. It's been very, very important to me.
Great. Are you in remission now, or I don't know how that works?
Yeah, yeah. So I'm good. I mean, they zap me with chemo. I've got to take a pill every day to keep it away. But I mean, I'm healthy other than that. I'm like the healthiest person my age you'll probably find. But it was a shock because I'd done kind of everything right. And I had to go through and get this treatment. I'd take a few months off from everything I was doing. And but it was a valuable thing that I'm very glad it happened to me. It changed my whole life in a positive way.
Well, that's good then. Yeah, silver lining, right?
Yeah, exactly.
Yeah, yeah. Well, so and we met at the Ultimate Partnering event that was the handoff from Ari Mentor to Tim Mai, and you
Mhm.
want to talk about that?
Yeah, I mean, I'd never been to one of their events. I was there because of Tim, because I partner with him here in Houston. We've raised money on deals, and I had worked with him before. He's a person that's really involved in capital raising. He trains people to raise money for deals and fund to funds model. So I was working with him. So I came up there I wanted to go to the conference, and I also wanted to support him because I work with him on a daily basis. So I went up there to do them, and it was a really amazing conference. It was great people, super high quality, and I got a lot out of it, and it was great.
Good, good, good. Okay. Well, all right. And I promised you we were going to have you say your takeaway twice, but I'm doing it closer together than I did last time. Say it one more time.
Okay, my main takeaway for people is in real estate is focus on the Warren Buffett rule, which is never lose money. So go into the attitude like I don't want to lose money. I'm going to be careful. I'm going to invest. I'm going to put my money at risk, but focus on safe returns, fixed rate debt, very experienced operators, not going with complex business plans and risky deals. And I'm going to basically try to build wealth slowly and surely. And if you do that, you'll do really, really well. Where people get in trouble with real estate is they try to go from zero to getting really rich in 5 years. And it doesn't happen. It's going to take longer than that. And if you get ahead of yourself and take a lot of risk, you're going to have deals that lose money, and it's going to set you back where you're not going to achieve your goals. So look at it as like very careful wealth building formula, And I'm trying to not lose money. And if you do that, your returns will be better than most people's.
Terrific. Okay. Well, if you will, tell people how they can reach you.
Best way to reach me is on LinkedIn. So I'm on LinkedIn. My name is David R. Priest, Priest, just like it sounds. And you can see what I'm doing on LinkedIn. You can also book an appointment with me straight from there. So it's one of the best ways. There's a button that says book an appointment. Click that, and it goes right to my calendar, and you can book time with me.
Terrific. Okay. All right. Well, thank you so much for coming on. We'll put all that information into the show notes and people will be able to reach you then. Okay.
Okay. Thank you very much.
Thank you.